Welcome to our Freebie Friday video. It's Sade, and we're talking about the escrow account that's usually used by mortgage lenders. And the question today is what it really is the escrow account for. The escrow account is to help the lender to make sure they have enough money to cover the expenses that are related to the property so that they can protect their investment. And this also protects the homeowner's investment as well in the property. And the main expenses that we're talking about when we're talking about escrow account will be the property taxes as well as the homeowner's insurance. So hazard insurance to protect the value of that property in case there's an accident or like a fire or anything like that, or damage to the home. And so the lenders always, for the most part, prefer to be the ones in control of paying the property taxes and paying the homeowner's insurance because they have a vested interest because of the loan that they gave on the property and it's their collateral. And what they do is to build the escrow amounts into the monthly payments anyway, so that at the end of the year they have enough money to pay the property taxes and also to renew the homeowner's insurance policy. And so when they're doing that, they're doing an estimate based on what they've seen the taxes to have looked like in the previous years. They can estimate what might be needed, and the homeowner then pays every month the mortgage payment itself as well as the escrow payment. The escrow account would hold the funds. It's like a trust account. It would be held, the funds would be held in there and then applied when the taxes come due and when the policy payment comes due. And when the homeowner is paying regularly, this works beautifully. And for instance, if the lender thinks that the amount required between property taxes and homeowner's policy is about $5,000, the lender would ask for $5,000 as the escrow amount for that year. And then on top of that, the lender will build in a cushion in case their estimate is a little bit off. So they build in a cushion, usually about a fifth of the total estimate. So then the cushion will be $1,000. So the total escrow account requirement for that year might be $6,000 in our example. If it's $6,000, that doesn't mean that the homeowner pays $6,000 once a year, but the homeowner would pay every month, until the amount of $600 is paid. So that will be divided up monthly over 12 payments. If the homeowner is paying consistently on their mortgage payments, the actual amount requested or more, then the escrow account will be well funded. If not, there will be an escrow shortage or deficit at the end of the year. If there's a surplus, which happens sometimes when the lender overestimates what's needed, the homeowner can ask for the surplus to be refunded to them, but a lot of the loan documents say that the lender can actually hold that surplus and apply to next year's escrow account. So you could ask them for it because the lenders are required to give you an accounting every year, which is called the escrow statement or escrow analysis. You hear different terminology used, but essentially it's once a year they give you reporting of how they use the funds and how much was projected and how much they actually spent, and then whether you have a deficit or surplus. If you're in a pending foreclosure status or anything like that, most times you don't have any surplus and actually there's a deficit, because if the monthly mortgage payments aren't being made, then most likely the escrow account is being depleted at the same time, and the lenders will then turn around and take out of their pocket and make sure they're paying the property taxes as well as the homeowner's insurance policy. And sometimes they'll put what we call the force-placed insurance on there to make sure that their interest is protected, that the collateral is protected. And the reason why they turn around and start paying the property taxes is because property taxes are for the county and they become a tax lien, which would pretty much trump the mortgage lien. And the property taxes can cause a foreclosure to happen, and they're kind of like a threat to the lender's interest. So the lenders like to take over the property tax payments as soon as they notice that the mortgage payments are behind. They just have to step in and do that. So that would cause an escrow deficit in the end, and the homeowner will then owe, if you're in foreclosure, owe the total balance due on the loan as well as the escrow shortage or deficit. And that's how that factors in when there's a foreclosure. And so those are tips for you. Make sure that your payments are coming in regularly, and if there's a statement that's an escrow statement, open it to see whether there's a deficit that you can make up really quickly. Usually they're about $200 off, not so much off. And if there's a surplus, then see whether you want to ask for a refund on that, and see what your loan documents say about getting the surplus as opposed to the lender keeping it and holding it over for the next year. All right, that's our overview on escrow accounts. If you have any other questions, send them over, and look out for our next video, which is coming up next Friday. And send us more questions, and we'll be happy to do more of these videos for you. Happy Friday.